Hi, everybody. Welcome to another edition of Kuvera Insights. Today we have with us Shriram Ramanathan from L&T Mutual Fund. He heads fixed income at L&T Investment Management. Shriram has over 20 years of experience in the fixed income markets. Before L&T, he was the portfolio manager at FIL Fund Management, and he was a senior investment manager at Global Emerging Market Debt Asia at ING, Asia Pacific in Hong Kong. He's also worked with Zurich Asset Management in fixed income research and with the treasury team at ICICI Bank. So all in all, a seasoned fixed income professional with more than 20 years of experience. Shriram is by qualification, he's a CFA charter holder, and he has a MBA from XLRI Jamshedpur. He's an engineer from the University of Mumbai. A very warm welcome, Shriram, and thank you so much for joining us today.
Thank you, Neelabh, for having me on the show.
You mentioned, and I would just, on two of the things that you mentioned. One is you compared the investment horizon to a tax-free bond, but there is no tax-free for a roll fund that follow the roll down strategy. They are not tax-free, right? They would be taxed as per a normal debt fund.
Yes, but the important part is normal debt funds also have a very important and tax benefit, right? I mean, so if you get into a 3-year plus period, which is where your long term for a debt fund really comes into play, you can take the benefit of indexation, and you get a tax at a 20% rate with indexation. So if you really I mean, and that's one of the key reasons why FMPs also used to be fairly popular. Yes, for less than 3 years, etc., it's not really that beneficial. But for somebody who's looking at a 3-year, 4-year, 5-year investment horizon, your effective tax rate comes down dramatically, especially when you compare it to FDs or to any other types of fixed return kind of investment avenues, wherein you might get taxed at a marginal rate even for investment horizons greater than 3 years. In the case of a debt mutual fund, and which is the same thing that applies to a roll down product, you can get the benefit of indexation and a lower long-term capital gains tax that is there with that.
Right.
So typically, a lot of such investors would prefer to be in the growth plans of these kind of products, because that's a way you would take advantage of long-term capital gains with indexation.
The next thing that you mentioned that these are, these products are akin to passive, but they're not exactly passive. I mean, so because the fund manager has a role in selection of the
securities,
instruments,
the issuers, correct.
The issuers in which the investments are being done.
Correct.
They will be limited by the mandate that the fund has created at the time of the NFO, but it's still the fund manager plays a role in that. So in that sense, it continues to remain an active fund. The passive-ish quality comes from the fact that all the instruments will in which the investments are done will have a very tight range of maturities, such that the average maturity of the portfolio can be pre-specified, and therefore right. So that understanding is correct, right? Would it be accurate to say, and maybe I'm paraphrasing what you said, that when I get into a scheme which follows a roll down strategy, I know that I should be investing for X period, which aligns with the intended average maturity of that fund or fund's portfolio, but and therefore this is the return that I can expect from it. I mean, you mentioned predictability of returns.
Correct. Yes.
Under regulation, we cannot guarantee.
Absolutely.
Funds cannot guarantee any return, but they're definitely subject to less volatility because you're holding to maturity in that sense.
Correct. Absolutely. So clearly, there is no question of guaranteeing any return, right, in any of this, and that SEBI prohibits it, and no fund house would ever do. What is being communicated, and I think that is is a very good thing from an investor's perspective, is the underlying strategy to be followed. And the moment one communicates, again going back to that example, let's say if you have 3-year money, and your the roll down is following a 3-year roll down strategy, it is mathematical that if you hold that bond till maturity, you would get a certain set of cash flows which are known already. So unless there is a default or something like that in the portfolio, and which is where, like I said, if you are going for a top of the line AAA names overall, that risk becomes negligible. In that case, okay, this is my coupons that I'm going to get. This is my 100 rupees at the end of 3 years that I'm going to get. I know pretty much that I'm going to get this much. So I think that predictability part comes in not because of any magic or anything from the fund house side. It is just the fact that the strategy is following that, which also means that if you have an investment horizon, which is, like I had said earlier, different from the underlying maturity profile of the fund, you would be open to some amount of volatility, right? If you have, let's say, money which you wanted to deploy only for 1 year, and you came into a roll down product with the maturity, intended maturity of, let's say, 3 years or 7 years, whatever it may be, one needs to be prepared then that it is, you are taking interest rate risk, because there is a
Of
big
course,
gap
yes.
between your investment horizon and the underlying maturity profile of the fund, and that can work both ways for you. I mean, if you have a scenario wherein interest rates come down sharply during that period, like we all know, when interest rates come down, prices go up of the bonds,
NAV goes up. Yes.
NAV goes up. And that would mean that, hey, at the end of 1 year, when you look at the return of the fund, it will look like, hey, wow, couple of percentage points better than what I thought it would be. And one can take a call that, hey, I've made good money. It's an open-ended fund. I can get out, and which is true of which is the good advantage, I would say, of a roll down strategy, that you have that ability to assess and take a call at any point in time through that period, unlike an FMP where you cannot. Flip side is that if you are in an environment wherein interest rates suddenly rise sharply, and no, you check your NAV at the end of, let's say, 1 year. No, and again, we'll go to the 3-year example. It was a 3-year intended maturity roll down. After at the end of 1 year, suddenly you check, hey, what is my return looking like? You might suddenly find that interest rates went up, prices of the underlying bonds came down, NAV is somewhat lower than what it should have been if it had been following a straight, simple, linear path. And to that extent, your returns will look maybe a couple of percentage points lower than what you were expecting. Important thing is, what you were expecting is only true if you had stayed to the entire period.
To the period,
And
yes.
the second point that I would say is, there are additional smaller factors that can cause. So the broad range can be assumed to be, what one is looking at in terms of the targeted investment maturity date. But within that, we have to appreciate that these are open-ended funds, right? Which means money can come in significant truckloads at times. Money can go out as well. It's up to the fund managers to make sure you reduce what is called as impact cost.
Yeah.
And I know I'm getting a little bit technical, but I think it's important for investors to just know that this creates a little bit of, which same like in shares, right? When you suddenly go to a very illiquid small cap stock and you sell a big amount of stock on that, it is going to have an impact on the price. Similarly, you can have an impact price when you sell underlying bonds as well. And to that extent, there is that little bit of volatility that is, or the range, you can call it that, around the expected returns, etc., over this period. How do we mitigate that? To a large extent, a lot of us fund houses and fund managers try to mitigate that by, you will see most of the roll down products being in the most liquid bonds or instruments. Typically PSU bonds, the top
Yeah.
of the line AAA bonds, which
Triple A, yeah.
also means that no, the impact cost for those bonds is negligible at most times. There will be time periods like we have seen in the past where impact cost can be more for these bonds as well, but at most times it will be negligible.
Is there a difference in the TER for funds which follow roll down strategy and funds that don't?
Typically, no. I mean, the It's as much a strategic choice for the fund house as it is for any other product out there. Um, the However, the logic that typically prevails is these are relatively simple products, right? Usually, like I said, and there is no hard and fast rule about it. It's up to each fund house to decide. These are positioned at a very high credit quality space. Like I said, because if you try to do the same strategy in a double A or a single A portfolio, uh, the impact cost that will come
It's
will be
significant.
significant. And of course, not to mention the credit risk element, which a lot of investors won't really want. So typically, most products in this are positioned in that very high quality space, and which then means that, and you are also targeting a particular maturity date. So purely from that perspective, um, uh, fund houses would generally put these products maybe, let's say, at the low to mid range in terms of expenses overall, because of the fact that there's so much predictability already pre-built into the products.
Right, right, right. No, that makes sense. And how does one, as an investor, how do I identify? Is there is this a SEBI category, or is there some other way mechanism by which I can identify that this fund follows a roll down strategy?
There, first of all, there is no SEBI mechanism in play. So, if a fund house chooses to put its, let's say, corporate bond fund as a roll down strategy, they can choose to do it. You can pick a banking and PSU debt fund to do a roll down strategy. You can even pick a dynamic bond fund to be a roll down strategy. I mean, which is actually a bit of an opposites in some ways.
The
But
normal
it's basically, the important thing is that this product relies a large extent on continuous communication from the fund house to the various investors. Second is fact sheet and checking back a little bit. No, you don't need to do a whole lot. It's not a very painful exercise. All you have to do is really look at a fact sheet, which is, let's say, a year old or a 6 months old. No, and look at the average maturity which every no fund fact sheet gives for that fund. Is it following that particular track record since the time that particular fund started following that roadmap?
So as an investor, I should look at the fact sheet to figure out if the fund is following today before invest making the investment decision. If I want to figure out whether the fixed income scheme that I want to invest in is following a roll down strategy or not, I can check the fact sheet.
Not in terms of, it won't be mentioned as a roll down. There is no I think the primary source of information is talking to that fund house, either the salesperson or anybody who's really representing the fund house. Like I said, this is a very simple, open, transparent strategy. So fund
So
houses
fair
are going
enough.
to be fairly clear about it. Hey, for example, if you were to approach an XYZ fund house, and if you ask them, do you have any roll down products that you have on offer in your debt funds? They would say either no if they don't have, or they would say, hey, you know what, our banking PSU right now follows a 3 year, a 2 year roll down strategy. Our corporate bond fund follows a 7 year roll down strategy, and no, you can choose any of these products.
Is it possible for a fund to shift from a roll down strategy to not following a roll down strategy and move into a purely active strategy, and a roll down verse and the vice versa as well?
Um, Absolutely. Is it possible? The answer is yes. Um, but obviously, unlikely that funds would. It comes down to, like in anything else, right? You build trust, and especially in the mutual fund space, it's finally all about trust, and credibility, and what you build as a brand over a period of time. So I think that itself becomes a very important, in fact, much more than regulatory aspect. I would say it is about, okay, hey, we want to be in existence as a fund manager, as a fund house, not just for the next 1 year. We want to be there for the next 20, 30, 50, 100 years. Then you need to build that track record of credibility.
Uh, so let's say, let's assuming that everything else remains constant. Um, of course, not the scheme's portfolio, but everything else remaining constant in terms of interest rate scenarios and uh, the credit rating of instruments into which these investments have been done. Will a roll down strategy versus a non-roll down strategy, will I get higher returns, lower returns, or it is not a factor at all?
It is absolutely, you cannot compare the two at all.
Because it depends on the
Absolutely. The
market at
only
the time
only
you're in.
the only parameter that you have to consider pros and cons is one has predictability built into it. The other has an active element to it.
Shriram, I think we've covered a great amount of stuff on roll down strategy today. We've sort of got into understanding the nuances of what a fund manager is doing behind the scenes in a when they're following a roll down strategy. Fundamentally, we believe at Kuvera that fixed income mutual funds is a space which is relatively less understood by the retail investor, fundamentally because of their exposure to fixed instruments, meaning that you buy once and there's a maturity, you'll get fixed returns every month or every quarter or semi-annually and so on. And here, this is a portfolio of fixed income products. And you are buying a fixed income portfolio which undergoes significantly, all of that dynamics of managing that investment, matching the maturity is done by the fund manager itself, which is reflected in the NAV, of course. But it's very hard for investors to understand. And we hope that through our discussion today, we were able to shed more light on some of these nuances of fixed income mutual funds fundamentally. Thank you, Shriram. Really appreciate your time today and your patience in explaining
this. My pleasure,
this.
Neelabh. Yeah, I hope I've helped a little bit, at least in that process of maybe simplifying a few things about the fixed income funds. But the good part is, I think the topic on which we spoke about, rolled on products, are I would say relatively among the simpler products that intuitively investors can understand what's really happening. And again, going back to the history of FMPs and the way they have been a part of a lot of our portfolio, so one can get the changes and the improvements, etc., and of course the cons as well for these products. So hopefully we have dealt on a topic which has been a little bit easier for investors to understand. And thank you so much for having me as part of this conversation.
All right. Thank you, Shriram. Very good to speak with you today.
Sure. Thank you. Bye-bye.